Today's webinar topic is AI/ML models for market volatility forecasting, right? So as you all know, data science, machine learning, and AI is something which is applicable to all area related to quant finance and related areas. So this is one of the important areas where AI and ML is applied. So just wanted to have a discussion on this topic today. So to discuss on this topic, we have with us today Sanjay Bhatia. So just to briefly introduce Sanjay, Sanjay has done his MBA in finance and also has an MSc in machine learning and AI from Liverpool John Moores University. He has also done a postgraduate diploma in machine learning and AI from IIT Bangalore, working currently as a director for UBS risk modeling and analytics. So it's also part of the model risk management and control in the CRO function. Sanjay is a risk management and analytics professional with more than 15 years of mainstay experience in risk models and methodology space, encompassing Basel, Advanced AIRP, IFRS 9, IMM, and SSER exposure, XBA, FRTB, OTC derivative pricing, and other advanced modeling topics. He has previously worked with various foreign banks, Barclays, RBS, Citi, Credit Suisse, mostly in the risk consulting domain. Sanjay is also very passionate about teaching and imparting practical understanding and insights, and has been a professional trainer for corporate and investment banks. He has been one of our lead faculties as well. We have a very strong association and his area of interest in terms of teaching are in credit and counterparty credit risk, market risk, stress testing, stochastic modeling, quantitative finance, and also particularly machine learning related areas. Right. So with that, I'll hand over the session to Sanjay. But before I hand over the session, just a basic laydown on how we would go about the session. So first 1 hour, around 1 hour, we'll be spending time speaking on the topic Sanjay will be taking us through. And then post that, we would have a Q&A. So all, as I've requested earlier, also anything specific that you want us to discuss in realm of today's topic, please feel free to type in, or during the session, if you're having any questions, queries, please feel free to ask. You please feel free to ask. The mode of asking questions is in the chat window. Unfortunately, since the participation is quite large, we would not be able to unmute each and every one of you, but nonetheless, we want the session to be very interactive. So please feel free to connect over the chat with your questions, doubts, queries. We would be happy to take up everything, all questions as much as possible. Right. So with that, I'll hand over the session to Sanjay. I'll make you the presenter, and please feel free to start whenever you are ready.
Absolutely. Thanks, Nitish. Whether my slides are visible? No.
Yes, we can see your slides, we can see you, so yeah, you are good to go.
Okay. Thanks all for those who have joined for this exciting topic on volatility forecasting, and especially the a different paradigm of machine learning which has disrupted this volatility forecasting area. Generally, we are living in volatile times, and the volatility span has quite increased since the onset of 2008 2010 great financial crisis. And since that time, the researcher community across academia as well as across industry practitioners have made this their favorite topic, right? So they have interrogated more about volatility patterns, both at a very granular scale as well as at a very large scale in terms of the volatility term structure. So the idea here is that a lot of trades these days and trading strategies these days are based on volatility. So more nuanced traders do not trade the in prices, they rather trade in volatility. Hence you see a huge maybe pickup in the volumes of various products, derivative products, exotic derivative products like variance swaps, correlation swaps, volatility swaps, right? So all this huge interest by the market is owing to two facts. That first is that the uh, background is changing, right, and has changed quite a lot. The world has become much more volatile than it was a few decades ago. And the second aspect is that with the advent of machine learning and data driven modeling and analytics, uh, the area itself has got a new thirst in terms of that now we are well equipped to do the volatility modeling, and especially in a high frequency data, on a high frequency data, right? So we are going to cover all of this, but before maybe I'll move on to covering a case study on volatility forecasting using a machine learning technique called neural network. I'll spend some time in order to bust some of the misconceptions, to disambiguate some of the stylized facts about volatility, because generally, though it's a topic of interest in general broadly, but many researchers, they don't understand spend time in understanding the volatility as a on its individual merit, and what are its characteristics, what are its stylized facts, right? So first of all, the market volatility, as we know, uh, the market volatility as we know is not directly observable. Now, what we mean by that is that we can only indirectly observe it, though it is not directly observable. Uh, Unlike price and the change in prices, which we can observe directly, right? There's no single unique or true value of volatility. Volatility is always indirectly observed by observing the prices or observing the change in the prices, right? And that's all more the reason that the volatility is always measured for a period, right? For a specific period of time. You cannot literally say that what is my volatility at a particular point in time. Rather, you would always associate the volatility to a time span, right? The fact that you wait for the price or change in price data to come, and maybe based on that you establish what is the volatility for that particular time span. Because the volatility is not directly observable, we always have to observe it through prices and change in prices. Now, this inability, maybe the general inability for anyone to directly observe the volatility, right, uh, create a lot of challenges in ascertaining the accuracy of the estimate. Like whatever your model is going to fetch out, like this is the implied volatility or realized volatility for that particular time span. You need to, as a modeler or as a quant professional, you need to spend quite a lot of time in order to prove its efficacy and accuracy, right? So despite having multiple benchmarks, like we already have since I told you that last decade and a half been so, which has been a very tumultuous in terms of interest in gaining interest in volatility, market participation in volatility, the trading volumes in various volatility based derivative products, the many hedge funds and boutique investment banks playing out the volatility strategy, novice volatility strategy. Now, all of this has gained a lot of ground, but and this has led to development of multiple benchmarks as well, like S&P 500 index. If it is an equity index, it is a representative of the equity markets in US, right? You have S&P VIX volatility index, which mimics the, or which mirrors the volatility of that particular index. So similarly, for every main indices across the world, right? CAC, DAX, FTSE, right? You have some or the other volatility index, which clearly showcases what is the volatility of that particular price index, or that particular market, right? So in nutshell, what we are saying is that volatility can only be observed through prices and change in prices, right? And it is only after the realization, the price or the change in price realization process ends, that we start analyzing the volatility. It's not that we can pre tell or foretell some story about volatility without observing the prices or without observing the change in prices, right? So that's quite essential thing for everyone to understand. The second thing is, that's for that reason, for that sake, we always measure volatility over a time span, right? We don't measure it for a particular point in time, but we rather measure it over a time span. And then the inability to observe volatility directly, right? Have some place some more burden on proving that your estimates are accurate, and you need to do some kind of a benchmarking of those particular estimate vis-a-vis the major benchmarks. And now that a lot of traction has been into this area, the well traded volatility index, previously they were there but not that well traded or not that liquid, but now they are well traded and liquid indexes of volatility, which summarize the volatility of a particular market, right? So that's the point number one, the indirect observability. The second thing is, volatility is a stochastic variable. By that we mean that it's not constant at any point in time. It is time varying, right? It does the random walk. It just do that kind of a white noise process, which does the random walk. It keeps on oscillating. And that's why for there are many models which generally have been in used by many practitioners. But the point is this, that some of those models, like Black-Scholes model, which is used for option pricing, assume the volatility to be constant or deterministic, but that should not be the case. That is one of the weakness or unrealistic assumption, or maybe baseless assumption, or maybe oversimplifying assumption of Black-Scholes. So when you are specifically designing your strategy, or trying to do trading in some volatility based products or derivatives, stay away from these models which for very oversimplification sake assume that volatility is constant and volatility is deterministic, right? uh, Realistically, for real life scenario, volatility is a very wild animal. It is a very wild mammal. It is stochastic. It has a random walk. It is very time varying, right? The other part is that one interesting fact which makes modelers and quant professionals and maybe data scientists and machine learning experts who are working on the subject very excited about volatility is that there's something for them to mine the data, because volatility is auto-regressive. Now, what is auto-regressive is that the next volatility, the future volatility, is dependent upon the past previous volatility. There's a lag with some lags, right? So the previous volatilities could be used, whatever the realized volatilities are, in the recent past, could be used to predict the future volatility. So that is called the auto-regressive process. uh, Obviously, the lag need to be established. What lags, you will go backward in time to identify that the what uh, time stamp volatility is more useful for predicting the future volatility. That's another aspect, but right. So volatility is highly auto-regressive, that it gives shape and form. Every previous volatility gives shape and form to the next succeeding volatility. So preceding instances or preceding observations of volatility could be used empirically to forecast future volatility, future in time, right? And due to this particular auto-regressive process, even for very very back of the envelope calculation, which generally I have observed traders do, right, or many broker dealer firm do, or maybe market makers do, is they simply calculate 10-day historical standard deviation of returns, right, to make a guess on the tomorrow's volatility, right? and uh, uh, and that in itself show that in practice, this is not just in theory, in practice as well, many traders, right, who trade vols, right, they rely on previous realization of volatility to get a sense of where the volatility is going or heading towards, right? So there's a in the market there's a rule of 16 as well, right? There's a rule of 16 as well, which means simply that you can convert daily volatility into annualized volatility and annualized volatility into daily volatility. A simple example is that US has 252 trading days, where this 16 rule came from. US has 252 trading days. You take the square root of that, because that is the number of trading days in the year. You will get around 15.8 something value, which is 16, right? And all you need to do is, let's take an example. A 1% daily volatility means 16% annualized volatility. Similarly, a 32% annualized volatility means 2% daily volatility. So this is a 16 rule, which is very prevalent in the market as a market practice to maybe convert the volatility from annualized to daily or daily to annualized, right? So generally many traders use it very oftenly, and maybe while dealing in the markets, right? And the other part which is very important is that although the volatility is auto regressive, but say generally the market practices that always do it on the close to close price, right? Like yesterday close price or day before close price, right, could predict what would be the close price on the next day or next to next day. But this kind of tracking of volatility from close to close, market close to close, or adjusted close to close prices, lose one particular thing, which is the volatility patterns hidden within the day, intraday, right? That's where, this is the area where high frequency data and high frequency trading comes in, right? And where machine learning gains momentum, right? Because machine learning can handle a lot of data a lot quickly than your traditional time series model like arch gauch models. So machine learning can be employed to specifically interrogate what is the intraday pattern, and how that intraday pattern is setting a tone for the next day volatility. So that's the key point over here, that any large variation on a daily basis, close to close basis, right, uh, could also be driven by these you know intraday patterns. Sometimes we call them time of the day pattern, or sometimes we call them diurnal pattern. Diurnal means, there are specific different patterns to it. Diurnal means when the market opens and when the market close. Is there a pattern? There are weekend patterns. When the market close on Friday and opens on Monday, what happens over the weekend? So the first one is during the day, right? When the market opens and when the market close, right, exactly at those point within the initial hour of market opening, ringing bell, and market closing, what is the diurnal pattern, right? Whether the volatility spikes, right, or falls or whatever, right? So that is the daily intraday pattern. Similarly, we have weekend effect. Market closes on Friday, opening up on uh, you know uh, next Monday. What is the pattern? What happens over the weekend? How the volatility reacts, right? Because markets sometimes take time to absorb all the information what has already happened on Friday, during the Friday session. right? Similarly, holiday period, right? So all these different breaks into the continuous trading, right? These are different breaks into the continuous trading, lead to some kind of signals which are completely missed if you just confine yourself to looking at day to day or close to close patterns, right? So hence, the first thing is, in order to capture the essence of all these patterns, you need to choose a measure of calculating volatility, which include not just close prices or adjusted close prices, but also high, low, uh, open and close, all these different prices of the day, right? Then only you would be able to appreciate or fully capture and encapsulate in your model that what are the patterns which are hidden within the day, right? Or which are associated to these discontinuity in trading sessions, right? So that brings me to the next very important characteristics of volatility. Let me maybe just a minute. Yeah, so that brings me to the next characteristics of volatility, that the volatility has two kind of components, right? And both these components should be given their adequate space while doing the modeling. The first component is the continuous trading. So during the day, you are continuously trading, so there's no lunch time, there's no breakfast break, right? Trading is happening throughout as long as maybe the markets are open. But then after the market, right, when the market closes, right, there's a break, discontinuity, then the market reopens, then there might be a weekend, right? Then the market again discontinuously get stopped, right? The market is not functioning, right? Then due to holiday calendar days, right, the calendar day effect, so all these points create some gap in the continuity of a continuous random variable, which is volatility theoretically is continuous, but the discontinuity of the market brings in some kind of discontinuity in the evolution or the dynamics of volatility. So volatility, uh, due to this very fact, volatility exhibits some kind of a jumps, right? There would be jump in prices due to this discontinuity, which captures some sense of volatility, how the volatility behaves during those particular uh, you know uh, uh, sort of discontinuity in between, right? So the point is this: a modeler should not ignore these patterns, right? If you simply confine yourself to when the markets are open and when they are functioning and operating, and leave everything else aside, what is happening when the markets are sleeping, right? Then you won't be able to truly capture the holistically capture the character of the volatility, right? So that's what my second point is. And sometimes this brings in a scope for improving the volatility forecasting or estimates, but also is equally challenging, because sometimes these two things, the continuous and the discrete components, are tricky to reconcile, right? Are tricky to reconcile. What happened during the continuous trading and what happens during when the markets are closed, right? It's difficult to reconcile, and that's why we need more data. This has to be very data intensive process, and that's why again a business case for machine learning algorithms, that they need to chip in, because traditional gauge arch or time series models or ARMA models cannot handle that kind of huge volume of data, uh, huge velocity with which that volume is flowing to you, right? So they cannot handle that much, right? And these models are not good at uh, modeling high dimensional problems. So we will talk about high dimensionality in a little while, but the problem is that traditional statistical models could not fit the bill if you have to do the volatility forecasting in a way capturing all the dynamic evolutions of volatility through the daily spans, as well as maybe a pattern which is seen day to day or week to week or month to month or quarter to quarter or year to year. That's so as you go from very short horizon, which is high frequency, to a low frequency, right? You need to capture all what is there, right? All kind of patterns, and that's where it is very important for us to employ machine learning algorithms on this kind of a problem sets. uh, the other the last but very important and essential part of volatility is that volatility is exhibit conditionality, right? And in mathematical terms we call it conditionality, but in market we call it volatility clustering effects, right? So conditionality means that the next state of volatility depends upon the previous state, right? So the previous state is this, the next state is this, right? The next state depends upon the previous state, right? So it's a conditional probability, right? So if during certain periods, if you are already seeing that the market volatility is getting higher, right? So there are highly likely chances of next few trading sessions, next sessions or subsequently next to next sessions, to be equally growing higher, right? So the high volatility trading sessions cluster together. Similarly, the low volatility trading sessions cluster together. So that is called volatility clustering. That's why we sometimes call it a regime. Are you operating in a high volatility regime or a low volatility regime? Because volatility tend to cluster together. There would be periods or trading sessions which will come, and they will be almost having the similar kind of amplitude, right? Or maybe higher amplitude would cluster together and lower amplitude periods would cluster together. So that is the conditionality or volatility clustering. But as you go distant into the future, uh, a recurring pattern of volatility clustering would descend down, would decay and come down to the normal level. So it somehow it is assumed, as long as other we are talking about in general many financial equilibrium models, that the financial prices tend to move back to their equilibrium level, which we call mean reversion. So the volatility is also expected to do some mean reversion in the medium to long term. So despite the fact that it clustered together, right, it clustered together, there would be high volatility period, but then at certain point in time that high volatility period would go back to its long run mean. So that's the typical characteristics or stylized facts about volatility. Now, to summarize, what kind of challenges it poses and what is the base case of machine learning over here? Volatility exhibit non-stationarity. It's a non-stationary time series data. What does it mean? That volatility, the distribution of volatility, right, if you plot it, right, or the squared variance would change from time to time. It's not constant. If you take last 10 years data or 15 or 20 years data, you see, break that particular data into 7 years, say 21 years data, 7 years, you see the volatility, the distribution of data is not same. So that is called heteroscedasticity or lack of homoscedasticity in the distribution, which means nothing but that the time series is not stationary. Stationarity means that the uh, distributional properties like mean, variance, skewness, kurtosis are not constant over time, right? As long as they are not constant over time, the time series is non-stationary. Volatility as a time series is non-stationary. So that's one challenge number one. The second challenge is market illiquidity. Now, when the market generally exhibit, because under the very simplifying model, you will always assume that the markets are perfect, markets are complete, right? There's no entry exit barrier, right? People do not have transaction costs, they do not have too much of capital gain tax to pay, right? There's no transaction cost, or maybe which is punitive for somebody not to participate, right? And in favor of somebody who bring in huge money, like institutional investor, who could bring down the cost and participate and achieve economies of scale, right? So we assume that the market is complete, market is perfect, market is liquid, right? The trading is happening and everyone is getting the same information. There's no information asymmetry among different players in the market. Like institutions do not have very significantly high degree of information than a retail investor or different institutional investor, like hedge funds or mutual funds or pension funds or endowment funds or sovereign wealth funds. They do not have different level of information, right? So that is a simplifying reality. But under the realistic assumption, the markets sometimes are imperfect. They characterize illiquidity as well. And sometimes the volatility also captures the liquidity dynamics of the market as well, right? The more the market is going to become illiquid, right, the more there would be volatility, heighten the volatility, because people then, in the anticipation that a particular stock or a particular bond or a particular maybe bitcoin would not be would be affected, its price would be affected by illiquidity, would try to trade its volatility, would try to take positions, right? So that's markets are illiquid. Volatility clustering I have already explained. The intraday volatility and high frequency patterns, which are very key, essential if you want to really have a something like a algorithmic trading kind of a if you are an algorithmic trader and if you are dealing in volatility based trading, right, or high frequency trading, you need to capture the intraday swings and movements and maybe fluctuations. Without that, it doesn't complete, it doesn't make any sense. The other part which are challenging is the black swan event. Now, mathematically, a non-stationary process whose distribution is not constant or not same across different time spans is affected by black swan events. And some of the events like COVID-19 or maybe leave a lasting impact, and dent on the non-stationary process, right? If if a process would be stationary, still there would be effect of these extraneous factors or some kind of a black swan events, right, which have very low probability of happening but still happens in once in 100 years or 200 years or whatever, right? So but on a stationary process they leave only temporary effect. On a non-stationary process they leave lasting impact. So that's why the volatility price dynamics, volatility evolution is highly affected by the black swan events because they leave the lasting impact, right? And under all these jugglery or maybe sort of cocktail of things, now the animal spirits lie in how to specify the model. That's the challenge, right? How to specify the model. What do you need? You need to first of all understand that. Now you know the stylized facts, components, and characteristics and salient features of volatility. What else you need? What do you need? What does it tells you? What is the tall order it plays on your desk as a modeler? You need to have a, a sort of a method or a technique which is very good at handling high dimensional data, right? You need to have a method or technique which is very good at handling non-linear relationship. You need to have a method or technique which is very less prone to overfitting, right? When you fit that particular method or technique on your data, it should be less prone to overfitting, right? You need a method or technique which is very real time, which could be calibrated in real time as the markets change. Suppose today is my I'm operating under high volatility regime due to Russian Ukraine war, right? Now tomorrow, if there's a treaty between Russia and Ukraine, and maybe the things would settle down, and the different Western bloc versus non-Western bloc, all these polarized world, and how trading is getting affected, right? How different maybe imports, exports, and supply chain are getting disrupted. All this will settle down somehow. Same is the case with maybe Israel, Palestine, or Israel Iran versus Iran. If this war situation will, which is a black swan event, right, if this settle down, dust will settle down, then basically we would be in a regime of low volatility. Now this volatility regime, as it changes from high volatility regime to a low volatility regime, this switch over effect, right, this switch over effect requires the model to recalibrate, and the model should recalibrate automatically. So we need an autonomous model which could recalibrate based on market data, right? We need not to every time go to the model, right, and change things manually, right? It should recalibrate based on the market data, and especially with high frequency and medium frequency data, because every time the data would not, would be change, and it could drastically change based on different regimes. It could change because of the inherent heteroscedasticity nature of the volatility. So as the data would change, right, your model should all also dynamically change. So a sort of autonomous dynamic calibration, autonomous dynamic reparameterization, all of that, the dynamic and autonomous part is very important, which is now all these things, the handling high dimensionality data, right, uh, uh, you know uh, uh, maybe some immunity to overfitting, right, some kind of optimization, auto calibration, auto parameterization, right, uh, you know and also some immunity to noisy data. The trading data is very noisy, right? So we need a strong algorithm which could segregate noise from the signal, right? So all those inherent properties make machine learning models, specifically neural network, the de facto choice for modeling volatility. And now the topic of maybe there are other topics as well which are coming up, as additional research focus into the volatility modeling, like climate and sustainability risk, like alternative assets, like maybe whether it's be carbon trading or cryptocurrency trading, right? Now when these kind of other topics are also somewhat impacting the market, right? So you have a variety of the volatility is further going into high dimension. It's not the same low dimensional or medium dimensional data. It is further going spinning into high dimensional, and you definitely need a machine learning driven solution to maybe model volatility, right? So on this particular slide, I'm going to uh, start from maybe a particular use case, right, of volatility modeling. And these are very high level details, because during my research on this topic, and when I was writing my research thesis on this topic, I created a model, right, for volatility forecasting, right? But still today, even I feel that there could be more to it, right? I could not do justice by writing one research paper or one thesis, or maybe doing creating one model, because every year on year volatility is showing us different things, right? And the volatility trading and the trading strategies are becoming more nuanced, right? So first of all, you need to understand that the volatility uh, has different concepts. You keep knowing about volatility from the market. Sometimes some papers say realized volatility, some papers say historical volatility, some research papers say implied volatility, but each of these have separate meaning. They are not interchangeable words. Realized volatility is, right, it's an approximation. It's not exact science. It's an approximation where we integrate the variance in the return, right? The variance in the return using a quadratic variation theory, right? And since I told you that our time series, financial time series, is not as continuous, it is rather discrete, right? With discontinuity coming from the daily closing of the markets, or maybe the holidays, or the weekends, right? So the nature of the time series is so that it is discrete. However, our volatility by theoretically is should be treated as continuous, right? Because you are stopping the markets, but you are not stopping people to take views on volatility, right? You're not stopping people to absorb new information, right? You are not stopping news channel to report something about the markets, right? So that news flows, you know uh, and different, maybe with social platforms, different analysts over the weekend absorbing things over the weekend and putting their comments or giving future guidance and all of that, that is still happening, and people are quite continuously looking into it and forming views about how they are going to trade the next Monday, or after weekend, or maybe after the closing of daily markets, or maybe after some holidays, right? So they are, so volatility is continuous. So in order to convert a discrete thing, which is from data perspective, it is discrete because it is not directly observable, and the price and the change in prices uh, are discontinuous, right? It happens only after the markets reopens, right? So in order to convert that, we use some kind of a quadratic variation theory, where we integrate the variance, this discontinuous variance, and over the continuous time, right? So though it is unviable, so that's why we use an approximation, which is what we call integrated variance, right? And we generally uh, maybe do some provide some continuous evolution to the volatility. So that's one, that is called realized volatility. That's act as a proxy, which we calculate as taking the squares, sum of squares of returns within a small window, high, you know, uh, within a small window, right? Take a, like a weekly window, take maybe sum of squared returns, right? And then maybe use those particular thing as a proxy for your weekly volatility. Historical volatility is generally your day-to-day volatility, what you have already seen in the market, observed in the market through prices, day-to-day change in market prices, and especially the close to close method, like the daily close to close prices or adjusted close to close prices. The change in those prices is your historical volatility. Implied volatility means that, look, there, there's one thing in where we are looking at the real and actual data, and there's another thing we are looking at certain instrument or certain price discovery mechanism which can infer volatility, right? Like when you have different options with the underlying as vol, right? Right, obviously, uh, the option pricing, right, could be used to deduce what is the volatility, implied volatility from that particular option. So it is a backward calculation of volatility, right, which is backed out from the option price data using Black-Scholes model. It is as simple as that. So the CBOE Chicago Board Option Exchange, the its volatility is calculated on a 30-day expectation of the volatility using bid and ask spread, of the of the uh, of the market traded on S&P 500 index. So the point is this, that uh, when different, so there are two ways of maybe calculating volatility. One is, right, that you take historical volatility, which are basically close to close prices, and then you treat the change in close to close prices or day to day prices as historical volatility. That's very simple. Realized volatility, as I told you, when you are going to do some approximation how volatility continuously evolve, you are going to use some quadratic variation theory, where you will convert a discontinuous process into a continuous one, a time continuous one, which is an approximation how volatility will continuously evolve. The implied volatility is the volatility which is backward calculated from the those particular options or derivatives which are trading on volatility using the Black-Scholes option pricing model, right? And the closed form solution there, right? So many exchanges have, I have already told that they have their VIX volatility index, like S&P 500 volatility index, on which many of these options and derivatives on volatility is traded. With that as an underlying, you could calculate the volatility of the main index by taking the option data and then deducing what is the implied volatility from there. So that's pretty much the case. What volatility is used for in real life in banks, financial institution, funds, right? We use it for pricing, market risk pricing. We use it for market risk based capital. We use it for setting our trading limits. We use it for our portfolio hedging. We use it for our macroeconomic policy making, like Fed Reserve, uh, especially Janet Yellen, the monetary policy announcements, right? MPC, monetary policy committee announcements, whether to raise the interest rates or not, whether to normalize the interest rate in US markets or not. Besides other macroeconomic indicators like CPI, WPI, or unemployment data, or the workforce participation in the economy, another key factor which goes into their decision making is the volatility of the markets, right? So it goes into the monetary policy making as well, right? So besides in trading, we have many vol-based, volatility-based strategies, many dynamic trading limits, or even stop loss is sometimes could be based on volatility. We do portfolio hedging, market risk capital, right? We do capital policy making or investment strategy. All of that is an area where different volatility indicators are used, right? uh, now uh, Coming on to the supervised learning bit, the machine learning bit. So machine learning within its paradigm has a specific area called deep learning, and that deep learning provide certain models or techniques to which could work on sequential data. Now this is a time series data. I'm just reminding you and myself that this is a time series data, right? We have a sequentially ordered, chronologically ordered data points, right? Like maybe how a particular price variable has evolved, how a return variable has evolved, how a rate variable has evolved, how a volatility has evolved, how CPI has evolved, how WPI has evolved, right? So we have a time series, right? And this requires some kind of a sequential model. And the there the neural network comes into the picture. The neural network, the idea of neural network is based on the human brain and the neuron system, our neurological system, right? How it functions from your toe to your head, how your neurological transmitters, right, carry the message, right? And there's a sequence, there's a chain to it, right? There's chain to it. Everything which is getting processed within your body has a sequence to it, right? There's a sequential process. If I pinch your toe, the signal which reaches your brain is going through multiple you know pre-processes or layers, right? Our neurological system has is a layered system, right? Where each level do its part of the processing. Some of the lower layers do basic level of abstraction, take basic level of extract basic level of information about maybe the signal, right? The higher level will give you some kind of advanced level capabilities, like judging whether somebody has a malified intent or a bona fide intent while pinching you, right? Was it a new pinch, or maybe in good humor, or in good sense, or was it something bad sense to it? So those kind of thing maybe. So that kind of system is adopted. Algorithm, the architectural design of neural network is exactly how our neurological system functions within our body, a biological neuron, right? How it functions, and that is used for sequential modeling and especially time series modeling and uh, be it price forecasting, like where your ERMA, Cerimax, the time series model, Gach, Arch, these family of models previously were used. Nowadays, uh, due to the highlighted benefits of using machine learning algorithms, we are replacing them with more robust and more rigorous machine learning algorithms which could handle data well, which could bring in an aspect of big data, handling high frequency data, right? So that's where machine learning has a sweet spot nowadays, right? But a lot need to be done in order to understand those models very well, because as of now, to many people, right, the machine learning models, I'm talking about the decision maker, or actually the like the regulators, or maybe the trader himself, or the portfolio manager, or the portfolio head. These machine learning models are a bit black box as on date. So there are some research which is focus on explaining these machine learning models, how they arrive at the parameters of the model, how they calibrate the model, how what kind of forecast they do, right? What is the accuracy of those forecasts? Can those forecasts be tracked back to specific drivers? What are the variables, right, based on which such forecasts are done? So all these aspects, if well explained, I have no doubt, or not even a single niggling doubt, that the machine learning is will completely replace the traditional way of doing time series modeling or sequential modeling, especially the area where the concerned random variable is very stochastic in nature, like volatility, right? So let's maybe dive into, so these are some of the research and literature papers, right? You could go through them, you could google them. So there are different multi layer perceptron, which is a part of very basic neural network, which is used for intraday and daily realized volatility forecasting, right? um, and specifically on the diurnal patterns. Diurnal patterns, as I told you, when the market opens and when it closes, right? What is the jump or spike in the volatility, right? So somebody has used maybe, and it's very good paper by Zhang, right? Which applies this particular these models, the MLP, multi-layer perceptron, and long short-term memory, right? These are two type of neural network architectures which are used for intraday. I told you that intraday is one area of research focus where uh, people are generally putting a lot of effort, because this is generally not captured by your traditional way of doing modeling, right? Which was very much focused on close by close or day to day volatility, while ignoring the intraday patterns, right? Now the other paper which is highlighted is this Christensen, right, which tells you how to do penalized regression, and a combination of regression and neural network, comparison of regression and neural network, right, when doing modeling on the volatility subject, right? Then the next paper is on use for again realized volatility, but using recurrent neural network and specific long short term memory to forecast the limit order based limit order book, right, on a big data, right? So that is again a good paper, right? Then there are multiple papers which compare across traditional ways of doing modeling, like principal component analysis, or multi regression, right, or anima, or support vector regression, or ensemble, or lasso, or random forest, and compare them with the neural networks like recurrent neural network and long short term memory, which are the specific neural network used for volatility forecasting, right? So you could go through these papers. There are plenty of papers which are I've highlighted, and broadly what it says is that this is a new research focus. Both academically and industry practitioners are putting a lot into this to get it right. So the RNN LSTM, recurrent neural network, and long short term memory, has I have segregated these two papers that on this kind of neural network architecture, these are this papers. Then on gated recurrent unit, which is another type of slightly different type of neural network, these are the papers. And there are then some papers which are on hybrid models or ensemble models, a combination of pretty much many models together, right? So there are certain papers on that as well, right? uh, and The problem, let's discuss a case study to give, consolidate and maybe assemble what we have learned or understood about volatility forecasting, right? The problem always come to you to do modeling in a model free way. Like this, the model should choose a choice of method or technique which doesn't make any theoretical assumptions, like markets are perfect, markets are complete, the distribution returns or prices are log normally or normally distributed, the markets are liquid, the markets doesn't have an entry exit barrier, it has negligible transaction costs. So all these kind of theoretical assumptions which are enforced on traditional statistical models, if we want to do away with those, and we want a data driven way of doing modeling where data would tell us what is the distribution, whether the markets are perfect or not, and the model should be capable built in such a way that it could automatically take illiquidity effect, volatility clustering effect, diurnal patterns, intertemporal variations, intraday patterns, whatever the case may be, right? The model should be intelligent enough to pick up all these signals and then maybe tell us what is the next volatility or volatility term structure in the long term, right? So so that is a data driven way of doing it in a machine learning way rather than doing it in a typically statistical, classical, or conventional way. We are contemporizing this to do it in a data driven way, right? And then, there's a second problem, how to optimize these models like neural network. You need, once neural network is built, you need to optimize and make it efficient, right? So some of the parameters, hyperparameters of the neural network means how many layers you have built in the neural network, how many neurons are there within each layer, right? Need to be optimized. They need to be optimally selected. So that is another focus area, that once you build a model, right, it's all not done and dusted. You need to optimize the model, right? So that's another problem. And then the third is about the stability of the machine learning models, the reliability of these neural networks, and the explainability of these neural networks. So all these three things, right, put together, right, make a success story for the adoption of machine learning, especially neural network for sequential modeling and time series data, and specifically a non-stationary uh, time series data where our variable of interest is very stochastic time variant. It it it, it goes through multiple regime, like do some clustering as well, right? It clusters together as well during high volatility regime or low volatility regime, and so on and so forth, right? So these are so you could maybe read through this. Maybe this is a snapshot of you know uh, the model which I created, right, using the S&P VIX volatility index prices, historical prices, right? And then I these are some of the steps which were taken while creating this particular model. So you could maybe go through this in detail, and maybe it provide you a, at least a good level overview of what are the modeling steps while bringing up a model for volatility forecasting. And then this is the a simple design of that particular model, what was previously covered, right? Right. And obviously, since this is not a neural network topic, but we I have here put some theory around neural networks as well. These are the results of the model, right? And we have tried different architecture, like long short-term memory is one architecture, then gated recurrent unit is another architecture, then combining both, which we call hybridization, right? LSTM, long short-term memory and gated recurrent unit together, right, is a different architecture. So it covers the semantics or the design or of that particular neural network, right? How many layers are there, how many neurons are there, how many parameters need to be estimated, and then it compare the performance and the result set, right? Which model performed better than the other, right? And then maybe you could go through maybe this these additional material as well, which covers a good idea, a good crash course on neural networks, right? So this is what I was explaining, that it is inspired by biological neurons, right? And this is the exact same thing has been replicated in an artificial neuron, what is already there in our biological neuron, right? So then there's a distinction between feed forward neural network and recurrent neural network, and we are using for time series and sequential data, we generally use RNN and different architectures of RNN, recurrent neural network, right? So you could maybe read through this because recurrent neural network is more uh, you know adapt or designed to handle the sequence data or the time series data. So this is our choice of the model, and then these are different kind of neural networks, right? Obviously. And then you could maybe see through some applications of recurrent neural network and the feed forward neural network, right, on this slide. And this is for you maybe to uh, if you are interested generally in understanding the neural network, you could maybe deep dive into these slides, and maybe then maybe I think I'll maybe rather than going too much over, right? I would rather like to have some questions and some interactions, because ideally these sessions are meant to hear from people and clear their doubts and provide them some guidance into their journey if they want to prosper in this field, right? So I'll hand over to you, Nitish, if you may maybe then start the Q&A session, and we can then spend some time there.
Yeah, yeah, absolutely. So thanks so much for that wonderful informative session. We would go into the some questions that are there, so I will collect it for you. But before that, maybe just to give you a 2-3 minutes break, we'll quickly run through what we have been doing at IIQF and how people can utilize that. Those who are interested in uh, making a career in this particular field, so they can utilize the courses and all that we have been doing. So just a quick summary on that, and then we will go into the Q&A. Right. So I mean, by now most of you know about us, so I'm not going into this introduction about us, but yes, just a very quick summary. I mean, we have been at the forefront of quant finance and financial engineering and related education in India. I mean almost for like 15 years now. So we have been into consulting and education in this field. So anybody interested in making a career in this field, they can utilize the courses that we do, which are pretty deep seated and like again very comprehensive courses targeting to prepare you for different areas of quant finance and machine learning and data science applications in finance. Right. So I mean these are all part-time courses which are conducted on the weekends, very suitable for people who are working or like even full-time students of other degree programs, and to give you the opportunity to basically work on your skills along with your job or along with the other degrees that you're doing. So very quickly speaking, I mean, if somebody is interested in like learning about all aspects of data science and machine learning and its application in finance, so we have a course called Artificial Intelligence for Finance, which is about 9.5 months. It has 3 parts. The first part teaches all aspects of data science applications related to finance. understanding about data engineering, data structuring, big data, data visualization, all aspects in context of finance, which is covered over a period of first 3 months. Then the next part is like about 4 months, which covers all aspects of machine learning areas related to finance, understanding about the machine learning in general, your supervised learning, unsupervised learning, big data, NLPs and then neural networks and all that. And it's all this in context of finance. That's the second part. And third part of the course allows you to select one of the electives to super specialize. So there are 4 electives: AI for derivative valuation, AI for trading, AI for risk management, and generative AI in finance. So you can select any one of the elective as part of the course to super specialize. Of course, you can do multiple electives as well. But for that, you will have to additionally register and pay. But one elective is part of your course. And good thing is all this is modular as well. So if somebody doesn't want to do the entire course, they can actually learn a particular area. For example, if somebody is interested in only learning about data science for finance, they can do only the data science part. If somebody is interested in only learning the machine learning applications in finance, they can only do the machine learning module. Or if somebody already has a very strong background in data science and machine learning, they can directly do the specialization modules, one or multiple, right? So this is a set of courses which very comprehensively prepares you for machine learning and data science related roles in different areas of finance, right? Now, of course, we have, being a quant finance institute, we have very, very comprehensive courses which prepares you for quant roles in the industry as well. So depending on your interest and inclination and also on your background, how much deep you want to go on mathematics or on the risk management side, there are alternatively 2 courses in quant finance and financial engineering. You can maybe choose one to actually understand the quant field and make a career in that. If you are very comfortable with advanced mathematics, so you can choose this certificate program in financial engineering, which prepares you for the quant roles in a very deep mathematical way, teaching all the theoretical understanding of like the derivative valuation and pricing models or the risk models, understanding the maths behind it, and then implementations of the models in Python. So you are well prepared both theoretically as well as the practical model building. We have in the same domain, we have another course called Quantitative Finance and Risk Management, which is a relatively less math-heavy course, a lighter version of the financial engineering course in terms of the maths. Of course, it's a huge, a comprehensive course in itself, right? But teaches the derivative valuation and pricing models in a relatively less mathematical way. So, if somebody is not interested in going into too heavy mathematics, this is something they can look at. Of course, there is no compromise on the practical modeling. In this course also, all the derivative valuation and pricing models are covered both theoretically as well as like you learn the practical modeling using Python in this course as well. Yeah, in terms of the risk management coverage, the quantitative finance and risk management will be a course which will cover the risk management areas in more detail compared to the FE course. Also, a lot of people who want to go into quant trading or, in general, algorithmic trading. So if somebody has an interest in learning about how to build an algo trading system using different kinds of strategies, then you can also look at a course called Postgraduate Program in Algorithmic Trading. So these are all resources which are available to you, and these are the short specialization modules in AI that I was talking about, which can be taken up separately as well. So anybody having an interest in building a career in like the quant finance engineering or risk management or algorithmic trading or machine learning or data science applications in finance, so these are all resources you can utilize, right? And yes, here are some of the past students who have done our courses. They have shared their thoughts how they have utilized these courses. It's like just for you to understand how anybody wanting to make a career in this field, actually they can utilize all these courses to actually enter into this field, or if you're already working, you can actually go into different profiles using all these courses, right? Okay, so our support system also is there on the placement side as well. We do have a separate dedicated placement team which can guide you to to determine what kind of profile you should be selecting, and then we guide you into the entire process. So our support starts from in the inception itself. When you contact us, I mean, we do counseling, and then again we help you and understand basis your background, what kind of profile or what kind of jobs you can target, and then what kind of courses to be selected basis your profile and basis your interest. So often, I mean, during the course, all the faculties, they are all leading professionals from the industry, particularly in the quant, machine learning, or risk management field, just like Sanjay. And so basically, like, you can expect a good mentorship from this kind of industry leaders, right? And as I mentioned, there's a dedicated placement support team. Once you complete the course, they will work with you on your resume building, in your interview preparation, LinkedIn profiling, and then they will help you in connecting with the right opportunities. They will get you the interview calls and all that. Yeah, of course, being the oldest quant institute in India, with the industry connect is pretty strong. I mean, and we definitely leverage our connects actually to help our students to get the right jobs. Right? So, I mean, these are some of the target companies from these courses. Hedge funds like Renaissance, DSO, Citadel, investment banks like Goldman Sachs, Morgan Stanley, Deutsche Bank, commercial banks like JP Morgan, Citigroup, Nomura, of course, NYSE, NSE, and other the stock exchanges, all the consulting firms. Yes, a lot of people don't know that, like, consulting firms like EY, Deloitte, PwC, and all these guys, they also hire heavily into risk and quant teams nowadays, right? So of course, IT companies, MNC IT companies like Accenture, Cognizant, TCS, and another set of companies which actually maybe is not listed here is like all the apart from hedge funds, there are other trading desks as well, where a lot of our students go on to join, right? I mean, you can just look at, like, these are the kind of profiles that one can target, right? And yes, over the last 1.5 decades of our journey, I mean, practically we have interacted with, like, anybody, any company which works in the quant or risk management or related areas in India. So essentially, like, again, these are just like a very small set of names, but again, practically everybody who works in the quant and risk management area, we do have some connects. I mean, either I mean, we have been consultant trainers, or, like, again, we connect with them for placements. Our students anyway are there, like, again, in every company. So the industry connect is pretty strong. This is just a list, and as a part of our endeavor to actually promote the quant finance field, we have been we try to closely work with the leading educational institutes as well to promote this field in India. And I mean, we have worked with a lot of institutes. Again, it's a small set of institutes actually, which just to showcase the work that we have been doing, right? So yeah, this is our contact details. So anybody wanting to discuss anything, not only regarding the courses, but I mean, even otherwise, you want any guidance, advice related to all this, please feel free to reach out on this contact number, or you can email to us, or you can visit our website at www.iiqf.org, and we'll be happy to discuss. All right. So, I mean, with that, let's start, like, with the questions. I will collect the questions one by one, Sanjay, and then actually you can answer them. So let me see. Okay, so the first question is from Garima, and she has asked, can you share your knowledge regarding the use of AI/ML in anti-money laundering or fraud detection? I mean, would you like to take that question, Sanjay, in this?
Yeah, definitely. Am I audible?
Yes, yes, we can hear you.
Yeah. So thanks, Garima, for asking that question, and that's a very relevant question. So in the fraud analytics and in the journey in the compliance AML compliance area, right? We again have many time series. Like maybe and many neural net. So there are different models which could be employed there. The first is the fraud detection itself, which is a classifier model. You could use many of the classification algorithms like random forest or support vector machine, which are better classifiers. Why? Because in the AML and anti-money laundering and the fraud analytics area, the traditional models like logistic regression or probabilistic regression, they assume a linear classifier. However, maybe in many cases you definitely need in order to do the classification well, right, you need a non-linear classifier, right, which could really draw that particular boundary in a non-linear way between whether it is a fraud or not fraud, whether it is a AML breach or not AML breach, right. So you could use a variety of machine learning models, specifically classifiers like random forest, uh, many boosting, ADA boost or XG boost techniques, as well as different other classifiers like support vector machine, which are specifically far more advanced than your traditional statistical classifiers. And also for clustering thing, right, if your problem is clustering, which is unsupervised learning, where you have the data but you don't have the uh, observation about the target variable, you could use clustering like k-means clustering to cluster your data, right, and that is also pretty much advanced that than your normal clustering which you do using your statistical methods. So these are the two predominantly used techniques or methods or class of methods which you could employ. But besides that, neural network obviously there, right, because if you were to do some kind of a detection problem which would be based on images, right, or which would be based on some kind of unconventional data like maybe Facebook or tweet data or maybe social networking data or image data or whatever, right, you could build the neural network there as well, where there's a specific category of neural network, convolutional neural network, which you could build there. So there are multiple algorithms, and fraud analytics and AML uh, uh, research in AML areas has been quite adopting of these particular machine learning algorithms and techniques, right, to further advance their modeling arsenal. So that's very much there. Yeah.
Wonderful. So I hope that answers your question, Garima. Going to the next question is from Sanjay. Sanjay has asked, Sir, how AI and ML models can be used for quantitative valuation of companies as compared to traditional balance sheet valuations? Important metrics to consider and models that are actually useful practically. So, I mean, would you like to answer that?
Yes, absolutely. So when it comes to the traded firms, right, those which are well traded firms, we could use the option pricing model to value the company. And sometimes, the option, besides the black shawls and some of the traditional methods, you could use a machine learning models to arrive at the value of the firm or the price of the firm using their option, the traded options on that particular firm, right, the either the stock of the firm or the bond of the firm being the underlying to that particular traded option. So the machine learning models provide a way of I'm just reiterating, right, capturing high dimensional data, right, solving a high dimensional problem, solving a non-linear problem, solving a problem which requires so many variables, not just one, right, solving a problem which which is very noisy in nature, right. So all these inherent properties of machine learning models could be used. A typical financial accounting based balance sheet PNL models, I suppose these are gone. And the reason is that uh, 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 they are post facto information. Unless those financial statements are published and released, and those financial performance indicators or ratios are declared by the company, you won't get to know, right. Then you will only get to know, you are only valuing the firm once the cash flow statements, balance sheet accounts or PNL is with you, is already in the markets, right. So the modeling or quants requires some kind of a predictive way, or maybe where you could do things well ahead of time, and that would be just pricing and doing valuation based on option data or derivative data. And in that paradigm, the machine learning is quite effective, right? Quite a robust and rigorous model as compared to the statistical and numerical techniques. Yeah.
Wonderful. I hope that answers your question, Sanjay. If you have any follow-up question, you can please type in. But for the time, let's go to the next question, which is from Abhishek Mukherjee, and he has asked, what are the names for some models used by volatility index and hedge funds to calculate volatility?
Look, generally, what traditionally we both in literature as well as from a industry practitioner point of view, we used to see the arch autoregressive conditional heteroscedasticity or generalized autoregressive conditional heteroscedasticity model, or a specific model which is a HAR model, uh, heteroscedastic or heterogeneous autoregressive, autoregressive. So these kind of models are used for volatility forecasting as a specialized topic. But nowadays, right, many of these quant funds, specifically hedge funds or maybe the proprietary trading firms, they are employing recurrent neural network, and with two specific architectures, and the variety of maybe the architecture is same, right? But the how they build that particular architecture, how many layers, how many neurons within each layer, those kind of semantics, design semantics depend upon problem to problem. If something is very too stochastic, too much random walk, right, then obviously you need a deep learning. Means you will go deep, you will build a deep network, right? But broadly, within recurrent neural network, the long short term memory, LSTM, and the recurrent neural network, they are long short term memory and the gated recurrent unit, right? These two are LSTM and GRU. These are two specific kind of neural network and recurrent neural networks which are specifically used for volatility modeling nowadays.
All right. Oh, wonderful. So I hope that answers
And
your
just
sorry.
one point, while the Gauch, Arch, or even the stochastic volatility models are parameterized models, parameterized family of models, these are non-parameterized models. You need not to uh, assume any parametric distribution from which your data is coming. So the underlying data generating process is not bounded by theory that okay, it is going to come from this distribution. No, right? It is a data driven way of doing modeling. Whatever the data is, the data will itself tell you what kind of distributional properties it has, and the model will adapt accordingly. So this is a new way of doing modeling, not just technique differentiation, but also a new uh, kind of philosophy to it, right? That rather than a theory coming first and you following the theory, making certain assumption, building a model around that particular theory, testing data on the premise of that particular theory, this new paradigm is allowing data to tell us new insights, and we will theorize based on what data is telling us from data insights, right? So if it is going to have fat tails or skewed distribution or leptokurtic or mesokurtic, so be it. We are not going to enforce that it is going to be a typical this distribution or that distribution. Yeah.
Absolutely. Right. So yeah, I hope that answers your question, Abhishek. And any follow-up, please feel free to type in. We'd be happy to take it up. Next set of questions is from Gitika. Gitika has two questions. First question is, sir, can you name few libraries used for valuations of equity in Python? And so that is what the question I'll request you to take up. But before that, very quickly, so she has also asked, sir, can you tell cost of about all courses? Gitika, I mean, we would be happy to discuss one-on-one on the course, all the courses and the costs and all the structure, right? So maybe like again, everybody may not be interested in listening about the cost, but that we will definitely be happy to discuss one-on-one, right? So Sanjay, if you can take the first question, which is
Yeah.
new libraries used for valuations of equities in Python.
So Gitika, the main library is either stats models. If you want to build any time series models for pricing, valuation, forecasting problems. And in the machine learning, there's a library called scikit-learn, sklearn we call it, scikit-learn, right? So that library has all these methods, right, like which could you could employ from the machine learning arsenal for the same problem. So you could uh, so I would encourage you, if you are already into such subjects or exploring more, try to do both ways, right? Try to fit a traditional statistical models, right, from stats models, stats model dot tsa time series analysis. There are multiple methods within that, these arimas, serimax, right, gauge, egauge, arch, all these methods are there within the stats models library, right? And on the same problem build a statistical model, on the same problem build a machine learning model using, sklearn, scikit-learn, then compare them, right, on the performance and right forecasting capability. You would get to know maybe a good bit of idea which model is well performant and which is not on various parameters. Yeah.
Wonderful. Right. I hope that answers your question. Okay. So the next question is from Naveen, and sir, are these certification programs comes with 100% job assistance? So Naveen, as I was mentioning during my brief introduction, right? So yes, all these courses comes with a very strong placement support. How we go about it, as I mean, I briefly mentioned, but I mean, I'd be happy to discuss one-on-one. I mean, on how we would can help you. But yes, there's definitely a very strong placement support in case you can complete any of these programs. Right. So yeah, I mean, please, I will connect you with you one-on-one and discuss the courses and the placements as well. All right. So next question is from Imran, and he has asked, why I want to transition my career into HFT. Which course will be good and gives career break? Okay. Any suggestion from you, Sanjay, or shall I take that question?
I think maybe Nitish, you would also be able to add to this, but the algorithmic trading course, which is very specialized and where the use cases are very clearly carved out to cater to HFT trading, and also not only just HFT, but in general other algo-driven trading,
Right.
which is quantitative trading, and so that particular area you need to explore more and deep dive into, and that is the course, specialized course, which we have designed only for those people who are, who want to build careers in quantitative trading.
Yeah, absolutely. But just to add to that, see, Imran, the thing is about trading is that it's not like a thing that you just learn a particular thing and then you become a trader, right? So essentially, trading is an amalgamation of knowledge from lot of areas, right? So, I mean, learning about the market, learning about your different techniques used in trading, about derivatives, and then of course, I mean, if you're talking about HFT, then learning about computer programming, maybe hardware, software, right? Understanding about, like, again, and since we also apply a lot of quant trading, so essentially, as the name itself suggests, like quant trading involves two terms, or like again two words, right? So quant is understanding about the quant domain, and trading is of course understanding about everything related to trading, right? So there are two sets of areas which you need to focus on. I mean, ideally speaking, to be very honest, it's a combination of two courses that you should be looking at if you are apart from building a very strong background in like computers, both hardware, software, if you want to become go into HFT. But in terms of the courses, apart from the basic background, one, as Sanjay rightly mentioned, a course targeted in trading all aspects, in, I mean, quant and non-quant algo trading, postgraduate program in algorithmic trading. And if you really want to understand the quant domain, then maybe, like, depending on your background, either the certificate program in financial engineering or maybe certificate program in quantitative finance and risk management, which will teach you the quant domain, and the PGPAT will teach you the trading side, right? So of course, I mean, which one to do, or like, again, if you want, I mean, you may or may not want to do two courses, right? So we can discuss more in detail about your background, and then of course we'll be happy to suggest you, I mean, what would be the right chronology of courses, or particularly which courses to go for. But generally, this is what will be suggested. but we will be happy to discuss more one-on-one and guide you. All right, so going to the next question, which is from Paranjay Sarma, and Paranjay has asked, okay, so there are multiple questions actually. So he has said that it has been a great session, sir. Thanks so much, Paranjay. Great, thanks for your kind words. The questions are like, again, first thing, can we convert volatility, which is a non-stationary data, to a stationary featured data by method like fractional differentiation, and will it work? So I'll read his questions one by one, or second question is, as you said, that different types of volatility should be included in the model. Can you tell us like how to indulge the volatility model in a signal processing model for better results? So these are two sets of questions, two questions.
So very pinpointed and very sharp question. I must say, I appreciate that. And the first question is, can a non-stationary property, can it be transformed to stationarity? Look, Paranjit, this is the requirement, right? This is not on a non-stationary data. You could assume that that is a random walk process, and that is completely unpredictable, right? Uh, while doing fractional differencing or other methods like maybe some kind of a box Cox transform or some kind of a transformation, right? I'll just keep it simple, right? So what you are essentially doing, you are not changing the character of the actual phenomena, but rather you are transforming it so that you could make the distribution, the statistical distribution, non-varying across different time slots or time periods, which is that you are targeting to make a heteroscedastic into a homoscedasticity. That is the requirement. Why? Because unless you do that, right, all you can see is you are seeing the same time series, but you are seeing just a random walk. You are just trying to, after transforming, that particular noisy character of the time series goes away, and you could clearly see the patterns, right? So converting it from non-stationary to stationary doesn't mean that we are inherently trying to manipulate the time series. We are trying to reduce the noise level in the time series to only see those particular patterns which are key for modeling, right? So that's first. The second thing is, what exactly you ask is that with respect to different signals, like intraday versus maybe the close by close, close to close kind of method or other signals, right? uh, so what I would say is the best way to go about is, if you want to while you are practicing and as you become a seasoned practitioner of the subject, you should do a multivariate time series, right? Some signals should target the short end of the volatility term structure. Some signals should target the medium and mid end of the volatility term structure. Some signals should be targeted to tell you story about the long term equilibrium state or mean reversion property of the volatility term structure, right? With the combination, what you're trying to make, you're trying to build a volatility term structure. Once you build a volatility term structure or a model which could uh, you know make you forecast that particular volatility term structure for different tenors, you could be able to price anything and everything in this market, right? You could be able to not only price, you could be able to build strategies, do arbitrage between different tenors, right? And you could do a lot, right? And also this gives you a sense of the uh, uh, the structural dynamics of how volatility evolves from a shorter span to a mid span to a larger span, right? So but for those who are only confining themselves to high frequency trading, short end is important. For those who are mid-term investors, mid end is important. For those who are long-term investors, long end is important. You could then further decompose that particular term structure based on what kind of strategy you want to build or design, right? But it's like a more nuanced form of research, or a modeling model would be capturing different ends of that particular term structure. Because and if you are have a very specific topic, then that's fine. You could confine yourself to short end or mid end or long end, right?
Absolutely. Wonderful. So I hope that answers your question. Going to the next question, and we have already 10 past our allocated 10 minutes past our allocated time. So we'll very quickly take like some of the next 3-4 questions, right? And then we'll wrap up the session. So please be with us. It's like it's so many good questions actually. So maybe like again we would try to take up as many of them as possible. All right, so now going to the next question, which is from Samir, and he has said that, is there any program with focus on fundamental analysis using ML and combining risk management with it? Okay, so yeah, Sanjay.
So generally, Soham, right?
Samir.
Samir. So Samir, generally in our certificate program for maybe AI in finance, which is a long journey of teaching you the data science first, then moving to machine learning, and then letting you decide which particular specialized area you want to pursue specialization. Like then there are separate specialization or branching of it, like specifically for algorithmic trading or traders, applying machine learning techniques to trading use cases, or risk management or financial engineering. So there are different streams to it in the last phase, right? We generally teach both, right? The fundamental analysis is very important when you do the EDA, exploratory data analysis. But I would still say that how the modeling has evolved, or the quantitative uh, you know school of thought has evolved, that fundamental analysis are post facto analysis, right? Unless you have the balance sheet, cash flows, and blah blah blah, right? Or if you only want to pick a particular stock based on maybe some kind of a deep dive into their organic growth, or organic earning potential, or those kind of things, you could do fundamental analysis. So fundamental analysis corroborate or further complement, right, the uh, the portfolio selection based on algorithmic, different algorithmic way, which is a quantitative way. So first you ought to build a quantitative model which could allow you to select different maybe stocks based on your strategy. Like if you are playing a momentum strategy, or a volatility strategy, or a mean reversion strategy, or any kind of strategy, right? You should get a recommendation that these are the 50 stocks, or 40 stocks, right, you should be looking at. Then on top of that, the fundamental analysis would allow you, right, because you already are somebody from finance, and you want to basically, before investing money, you want to see what are the balance sheet ratios, or PNL, or cash flows, or cash generation ability of that particular firm. Then based on fundamental analysis, we could uh, specifically compare those 50 stocks, right? So that's the way forward, right? That's the right way of doing it. So generally in the market, people generally tend to spend a lot of time doing the fundamental analysis first, which ideally is not very uh, intelligent way of going about it. So that's where maybe the things should be first quantitative uh, you know analysis, and then based on the recommendation of your quantitative model, do fundamental analysis on a subset, or refined subset, or a filtered subset of stocks, right? but
Great.
but to your question, we will cover both, right? We'll cover both, because there are variety of techniques, and the same technique could be applied to doing fundamental analysis in a different way, to doing quantitative analysis in a different way. So we will cover these use cases, yeah, separately.
Right. So I hope that answers your question. Going to the next question is from Saurabh, and he has asked, please recommend some ML projects to attract recruiters of finance industry, and what are the skills necessary to crack the job? Okay. So first thing is, Saurabh, of course, Sanjay, please guide him. But again, first thing is that it would also help again if you can tell us about your background a little bit more, Saurabh. That would help us in maybe like again guiding you on like what are the additional skills, because first we need to know what is your overall background. But in general, Sanjay, do you want to answer that question?
Yeah, so there are multiple research areas as well as areas of heightened interest like climate and sustainability risk, even volatility forecasting, right? What we covered in today's session, right? Then you know pricing of illiquid assets, right? Like maybe cryptos or maybe carbon trading, right? So these areas are good research areas if you want to really stall uh, you know if you want to climb other shoulders and maybe make yourself notice, right, in the market. But before going there, for the general market, I could tell you, being involved in recruiting people and being involved in going to IITs and ISIs, these premier institute, interacting with students, right? I could tell you that the at an entry level you need to get very right with your basics, right? It's all about basics. Either you make it or you don't make it, right? But the criteria industry, you if you too much overread into it, it's not about doing some fancy stuff, it's about doing basic stuff, right? Because quantitative finance has not been that prevalent previously, and in the last decade and a half it has become so prevalent. Now there's a shortage of resources, right? There's a shortage of resources. So somebody who's very good with their quantitative knowledge and knowledge of domain, and also mathematically and programming wise is quite good at even basic models, right? You will easily get a job. It's not about getting notice or not. Obviously, if you, after learning those skills, if you could do some kind of a research or thesis work or some kind of a literature study on any of these evolving topics, that would make you stand out, right? Yeah, so yeah, that's
Absolutely.
yeah.
Absolutely. Yeah, I mean, and of course, again, we would be happy to discuss in depth about like your individual, once you know your individual background, and maybe like again, depending on your background, what more you need to do. But in general, exactly to the point, Sanjay. Thanks for that. So going to the next question, which is from Kirtan, and he has asked, while building an ML model, should you focus on anomaly or pattern detection, or on risk management model, or a combination of both? Which models can be used for long-term anomaly detection?
Okay. Yeah. So anomaly detection, Ketan, maybe is about outliers, right? Outliers, right? I would not segregate it, because unlike fraud detection or forensic analytics, where you are specifically interested in anomalies, right? The outliers, the extreme outliers, right? A sudden, maybe abrupt change in the behavior which could give you an indication there's something fishy there, right? But in all risk management models, anomaly detection, outlier treatment is part and parcel of risk management model. And we
Absolutely.
do we do day in day out, right? But it's part of the exploratory data analytics which we perform on the data set. And we see, like we use, if you have heard of the uh, what we call interquartile range, what are the values which are falling out way outside of interquartile range, we plot that box whisker plot. We always do find anomalies, we always find extreme values, because unless those are treated, you cannot go with extreme values and build a model. Unless those are treated, right, you cannot build a model, no matter which model we are talking about. This is in general, right? So anomaly detection and outlier treatment is part and parcel of the process, right?
Absolutely. I hope that answers your question. Okay, going into the next question, which is from Prathamesh, and Prathamesh says that he's an engineering student aspiring to be quant researcher. What path should I follow, and where should I start? Interested in HFT2. Okay, so allow me to actually start answering that question, and then please feel free to add up. Right. So Anyway, I mean, while answering one of the previous questions, we have mentioned about like to go about understanding about quant and trading and all that, right? But in your case, particularly since you are an engineering student and you are interested in quant and HFT and all that, right? So first thing is concentrate as much as possible on your mathematical and computer subjects, right? So since the more strong you are with maths and computers, I mean, more chances are that you would become a good quant, and particularly if you want to go to HFT, the computer skills, both hardware and software, will be needed quite there, right? So that is first thing. So that's for the basics, and then in terms of the specific courses, what you should be doing. Uh, First thing is like start with acquiring the quant domain knowledge, because that is something would be very difficult to acquire on your own. So maybe like since you're an engineering student, look at a course called Certificate Program in Financial Engineering, which absolutely in a very curated way prepares you for all the knowledge that is required to become a quant researcher or a quant modeler, right? So that is what you should be starting with, and then anything additional needs to be done or not, that actually can be decided, discussed, and later on. But yeah, first and foremost, concentrate as of now on like the mathematics subjects as much as possible, learning about the computers, both software and hardware, as much as possible. That's for the basics. And I mean, of course, it includes the programming languages as well. And then additionally, maybe you can look at the certificate program in financial engineering, right? I would be happy to discuss in more detail one-on-one. Sanjay, anything more you want to add on what I've said?
No, I think that's the case, right? You got to get started, and without maybe waiting too much, if you are really passionate about that, you got to get started with your full throttle certification program, which will get you every bits and pieces, nuts and bolts on the quantitative finance, right? And obviously, once you are through that, right, you will get a direction. If you we religiously pursue this course, the course is rigorous enough to give you a sense of direction, what specialized area, like whether it's high frequency trading or risk modeling or maybe derivative pricing or valuation, what specific area you should then get hooked on to and maybe would pursue then as a specialized area within quant finance. Yeah.
Absolutely. Okay, so now like again we'll be wrapping up the session in next 2 minutes. So anyway, like can we have taken up most of the questions. So first thing is Saurabh, as a follow-up, is mentioned his background as BTech in computer science engineering. So Saurabh, I mean in that case, while answering Prathamesh's query, right? I mean I've also maybe like answered your uh, question as well, right? On like where to start and how to go about it if you want to make a career in this field. And for Prathamesh, you have asked what basics to work on. So yes, I think this question was before I explained what are things that you need to work on. So as I mentioned, start with the basics of like the mathematics and the programming, or rather I'll say that whatever maths and programming and other computer related areas that you are doing, concentrate, go deeper on that, learn as much as possible, and like more on that we can discuss one-on-one, right? Okay, so now a follow-up question from Paranjay, and we'll wrap up the session with that. So he has mentioned that just a minute. So Paranjay has mentioned, is fractional differentiation a good method to convert non-stationary to stationary feature data? That's an additional question, follow-up question. So would you like to answer that, Sanjay?
Yeah, definitely. So it depends, Paranjay, right? Because what kind of data you are talking about, I am not well aware, right? Because there's no generic answer. Yes, fractional differencing is very much used, right? But also among fractional differencing, what we generally do, we try to apply multiple methods and then do some kind of a uh, uh, you know mm, some kind of a statistical test, right? Like AD Fuller test, augmented Dickey Fuller test, or some kind of a unit root test to examine that a particular method, which particular method has more appropriately converted our non-stationary series into a stationary series, right? So it is also subject to testing, right? You are applying a method, that's fine. You could apply multiple methods as well. That's the right practice. Why confine yourself to only fractional differencing? Apply multiple methods and then do perform AD Fuller test, right? To see whether the unit root null hypothesis has been adequately, there's adequate evidence to reject the null hypothesis, which is says that the time series is non-stationary or has a unit root, right? You want to reject that, right? Obviously, right? So that will give you the right inkling whether it's the right method for that kind of data which you're working on or not.
Wonderful.
Yeah.
Thanks, Sanjay, for that. Actually, I hope that answers your question. And yes, Paranjay, thank you very much. I mean, I really appreciate your kind words. And also, like again, for Prathamesh, he says that he is proficient in data science and already builds low latency systems. I'll work more on the mathematical side. Yeah, absolutely, Prathamesh. And if you need any help in collating and building a strong mathematical modeling background, then as I mentioned, I mean, you may look at this financial engineering courses. So wonderful. So with that, we'll wrap up the session for the day. I mean, thank you everyone. You have been a wonderful audience. The questions has been very, very interesting. I mean, it really shows your involvement and interest. I was really happy with the participation. And thank you once again, Sanjay, I mean, for the great session. It was very informative, and I believe all participants, you also had a good learning exposure today, right? So, I mean, we'd be happy to, again, as I mentioned, take on one-on-one more deeper questions if anybody has any, right? So we'd be happy to connect. Our contact numbers are given, so please feel free to get in touch with us. And as you all know, we regularly conduct this kind of webinars on very, very important topics related to quant finance, algo trading, risk management, machine learning, data science, and AI applications in finance. So keep track of our website, our social media pages, and of course, we will also intimate you through emails and other modes for the next sessions. So see you again in the next session. Thank you. Thank you very much. Thank you, everyone.
Thanks everyone. Thanks a lot.